Hello friends, welcome to the Manthan series of BFM. In Manthan series, we are covering all the subjects. Okay? ABM, BFM, BRBL, ABFM, all the 4 subjects of compulsory ones of CIB. So follow the series completely. Share it with your friends. Like the video, like the channel, subscribe to the channel, click on the bell icon. Don't miss this. Okay? Let's start. Today I'll be covering international equity and debt products, some numericals and some theory. Yesterday also you might have seen I have covered one important numerical on bond calculations, present value of the bond. Don't miss that. If you have not watched, watch it again. Okay? Let's start. The treasury bill is a short-term debt instrument issued by RBI, commercial banks, Government of India, public sector banks. So T-bills are issued by whom? RBI, commercial banks, Government of India and public sector undertakings. Who issues the T-bills? Treasury bills. Who issues it? Yeah? Treasury bills are issued by, kindly note, they are issued by RBI. Okay? They are issued by RBI on the behalf of government, obviously. RBI is a banker to the government, isn't it? What are the roles of RBI? Banker to the government, banker to the banks, banker of last resort, right? Supervisory, monetary and credit policy. These are the functions of the bank, isn't it? So, they are issued by RBI on the basis of, means on the behalf of government, but issued by RBI. Okay? So, next. What does WACC stand for? Basically in finance, WACC here we are saying in finance, what does it stand for? Weighted average cost of capital, working capital allocation calculation, weighted average cash conversion, working asset control cost. What is it? Yes? Yes? It is weighted average cost of capital. Kindly note, what is weighted average? See, cost of capital means what? Cost of capital means, suppose if I am getting some loan from some bank and then starting the business. Let's say I get a loan of 1 crore from some bank and start a business. That bank will give me at around, let's say 9%. So my cost of capital is 9%. At what rate I am getting the capital from someone? Now it can be very varying, means from the bank I am getting at 8-9%. Somebody, some private party might be giving me at 11%. Isn't it? It varies. So cost of capital, what is weighted average but? Weighted average means, see, always remember the concept of weighted average. Weighted average will always have your period multiplied by the loan which you have taken. Period loan multiplication. And latest loans or latest elements will have the higher weightage. Kindly note, in weighted average, latest elements always have the higher weightage. So that is known as weighted average cost of capital. What are the two averages then? One is simple average, second is weighted average. There is third one, that is called as exponential average. That's a separate part. So mainly there are two, simple average and weighted average. Okay? Numerical. A spot rate, current exchange rate for USD Euro is given as 1 USD equals to 0.85. So this is my spot. 1 year interest rate for USD is given as 2%. 1 year interest rate for Euro is given as 1%. Find a forward rate for the same Euro USD. So you have to find out the forward rate. Okay. So what is the formula for this now? Now this is a typical question which was asked in your June 25 also. This. Excuse me. So it was asked in June 25 also. Same question. Only the currencies were changed. It was INR, Riyal, Saudi Riyal and USD. Remember anyone? Saudi Riyal, USD and INR. These were the three currencies given. Same, but question did not change. So the formula for this is, kindly remember, see this, 1, okay, let me first see, yeah, pen is there. 1 plus C, 1 plus H upon 1 plus F equals to F upon spot S. Now what is this H? What is this F? 1 plus home currency interest rate upon 1 plus foreign currency interest rate equals to forward rate upon spot rate. 1 plus home currency interest rate upon 1 plus forward currency interest rate, foreign currency interest rate. That is equal to forward upon spot. Now what is the home currency over here? Now this you will have to think. Okay, say this. USD is given as 2%, Euro is given as 1%. Now it depends from where are you calculating. It depends on from where are you calculating. Generally, this USD is considered as a foreign currency. Generally. So this will consider it as USD. And this you'll consider as Euro. Okay, for us both are foreign, but let's do it because as the numerical is given, you'll have to answer. So Euro is a home currency and USD is a foreign currency. Now find out then. Now it's simple. So what is it? 1 plus, what is the rate of interest for home currency? Means Euro, 1%. Percent means what? Divided by 100. So it will be 0.01 upon, what is it for foreign currency? Dollar. 1 plus 0.02. So that is equal to what? Forward. What is the forward? We don't know. We have to find out forward. What is the spot? Spot is given 0.85. So now it's just a matter of calculations. Do the calculations now. Everyone try this. 1.01 upon 1.02 equals to F upon 0.85. Try this. Find F. So F equals to, forward rate equals to, so F becomes what? F equals to, find the rate, answer for this. Let me also try. These are the fresh problems which we get it. Okay. So 1.01 upon 1.02. So that is equal to what? 0.99. So this is 0.99. So F equals to 0.99 into 0.85. Okay, 0.99 into 0.85, right? So multiply this into 0.85. So it is 0.841. So forward rate equals to 0.841 something. Okay. So 0.84. Are you getting this? Everyone check. 2 digits are very important. First 2 digits. Are you getting it? 0.84. Now what can you say about this? Forward rate is 0.84. Present rate is spot is 0.85. So the currency Euro, this currency is in premium or discount? Present currency, present rate is 0.85. Future rate is 0.84. So are you in premium or discount? Means what do you mean by this? See, understand the logic. For buying 1 USD right now, to buy 1 USD, I'll have to give 0.85 euro right now. And in future, for buying 1 USD, I'll have to give 0.84. So I'll have to give less euro. What does it mean? What does it mean? USD has become cheaper. USD is falling down and euro is going up. That's what is the meaning. It's like buying the vegetables. If I buy the vegetable right now and I'm getting, let's say I have to pay 85 rupees right now for buying one vegetable, and afterwards I have to pay 84 rupees for buying the same vegetable. So that vegetable has become cheaper. Dollar has become cheaper, right? So dollar is falling down in this case. Got it? This is the way you should always find out this forward. This formula is very, very, very important. 1 plus H upon 1 plus F equals to F upon S. Okay? Home currency interest rate upon foreign currency interest rate equals to forward upon spot. Don't miss this formula. Okay? Don't miss the formula at all. Let's move on. The value of the bond is most affected by coupon rate, maturity, expected YTM, and all of the above. What is it most affected by? Many of you will answer this, all of the above. Check my yesterday's session. Yesterday's session I took this in details. These two are static, coupon, maturity, period. So C, N and F, static. They don't affect the bond value that much. Present value P and R, these are dynamic, they will affect. So yield to maturity is R. This is known as R. So this will affect the bond price the most. Always remember, whatever is static, whatever is not changing, will not affect anything that much. Because you know it. What is static means you know it, right? So it will not affect the bond price that much. And whatever is changing will always affect the bond price heavily. Okay? State true or false. Treasury management only involves managing short-term cash flows. Treasury management only involves managing short-term cash flows. Now, many of you will answer it as false, wrong. Treasury management also involves long-term. Here, agreed, it is false. False. Why? Because only is the wrong word over here. It involves short-term also and long-term also. But short-term is 90% is short-term, only 10% is long-term. Treasury's main role is short-term. But because of this only word, this is wrong. If it would have been mostly involves, treasury management mostly involves, then it would have been true. Okay? Got it, everyone? Clear this concept? Treasury management is mainly concerned with short-term funds, less than 1 year. Foreign exchange risk is a type of credit risk. Foreign exchange risk in terms of, let's say, bonds or in terms of forex currencies, it's a type of credit risk. Is it so? Foreign exchange risk is a type of market risk. It is false. It is a market risk, which it is not in your hands. Rate of dollar, is it in your hands? Can you control the rate of dollar? No. Right? You can't control the rate of dollar. Treasury bills are long-term debt instruments. T-bills are long-term debt instruments. Are these T-bills? Are these long-term debt instruments? Think. What is the duration of the T-bills? What is the duration of the T-bills? Duration of the T-bills is 91 days, 184 days, and the into 2. Again, 182 and 364. It's simply the table of 2. 91 into 2 into 2. Okay. So these are short-term instruments. Again, false. These are short-term instruments up to 1 year. Long-term instruments are called as dated securities or government securities. A company's cost of equity is always lower than the cost of debt. Company's cost of equity is always lower than the cost of debt. Is it so? Cost of equity will always be lower than the cost of debt. Is it so? Again, false. False. True. This is true. Cost of equity will always be lower than the cost of debt. Why? Because equity will give, you don't have to give a fixed rate of interest on equity. The main part is this. In equity, I can't guarantee you any return. You buy my shares, if I'm profitable, you earn. If I'm not, you lose. So there is no fixed binding on equity, isn't it? So the cost of funds for equity will always be lower than the cost of funds for the debt. Diversification helps reduce unsystematic risk. What is an unsystematic risk? Unsystematic. Okay. See, unsystematic risk means related to a company. See, there are two types of risks. One is systematic risk, second is unsystematic risk. Don't confuse this with systemic risk. Systemic is related to the entire banking system going down. Systematic is related to the industry, similar to systemic. See, again, there are two words. Systematic is also there. Systemic is the entire system collapsing, and systematic means only industry collapsing, typical banking industry. So that's why this diversification will help you reduce the unsystematic risk. That is false. It will help you reduce the systematic risk, not the unsystematic. Because unsystematic risk is related to your own company, internal. You can call this true also. Okay, sorry. This is true. True. This is true. Because if I have diversified portfolio, the risk of my internal company is reduced, becoming NPM, isn't it? So this is true. Got it? Kindly note, this is true, not false. Okay? This is true. Diversification will always help you reduce the unsystematic risk. Comparing to international mutual funds, Fund A with an average annual return of 12% and standard deviation of 8%, and Fund B with an average annual return of 15% and standard deviation of 12%. Which fund is better considering the risk adjusted return? So which fund is better? Now this is something different. This is a typical problem which might be asked. See, they can ask you in name of fund also. This they can change it. They can call it bond. This they can call it debenture. This they can call it equity. Anything can be called. Logic is one instrument and second instrument. There are two instruments, A and B. Okay? We have to compare them. Which instrument is giving better returns? So how will you calculate this? There is a hint given. Calculate Sharpe ratio. What is Sharpe ratio? Sharpe ratio means return minus risk-free rate upon standard deviation. Return minus risk-free rate upon standard deviation. So what is the return over here? A return of 12%. What is the risk-free rate over here? Risk-free means what? Whatever is the standard deviation. That is my risk. Okay? What is my risk? Always look at this. What is my risk? What is my risk-free rate? Risk-free rate is a benchmark. Now this benchmark, have they given any benchmark over here? No benchmark is given. So you take your own benchmark. Let's say what is the average rate? 12 and 15. Let's take the benchmark as 10. We will fix our own benchmark. After all, we have to do just the subtraction. So let's say the benchmark rate, equals to 10%. Now this you can assume. You can assume 12% also. You can assume any rate. So now find out for both of them. Sharpe ratio for both A and B. So find out for A first. A. So return minus risk-free rate. What is return? 12%. So 12% minus risk-free rate 10%. The whole upon, what is it? Standard deviation. What is it? 8%. So solve this. 12 minus 10, 2. 2 upon 8. Okay. So percent means getting cancelled. So 2 upon 8. So it is what? 1/4. So 0.25 or 25% you can call it. 25%. Okay. 2 upon 8 means 25%. That is for A. What is it for B? B equals to 15 minus 10. The whole upon. What is the standard deviation but? Oh, standard deviation is huge. 12%. So upon 12. So 15 minus 10 is what? 5 upon 12. Just looking at the returns, you will feel that 15% means huge, but standard deviation is huge. So get the returns. What is it? It is 12 fours of 48, 0.41, right? 12 fours of 48 and 20. So multiply this with 100, 41%. Are you getting this 41%? Right? So who is better performing? The fund with higher Sharpe ratio offers better risk adjusted returns. So who is performing better? This will give you better risk adjusted returns, right? B. So B fund or B bond will be performing better and it will give you better risk adjusted returns. Okay? Got it? This is an important numerical to find out the risk-free returns. Risk-free returns in international treasury. Very important ratio. Okay? Now before going, let me show you the new batches. Join the new batches ASAP. Okay? In fact, I would suggest you see how to join this. First, download the app. Download the app through Android as well as iPhone. Both of them available. So download the app first. In the app, you will be getting 1% extra. Don't miss this 1% also. Okay? And join this CIB Increment Mahapack. It is one of the best Mahapacks. It gives you e-books plus physical books, both e-books and physical books. 15 plus batches per subject. 15 plus per subject. Plus you are getting AI, it's AI assistant. Plus you are getting e-books, tests, mock tests are to the level of chapter wise, as well as chapter and as well as full length. And right now remember you are getting double validity offer. Double validity means what? You buy for 6 months, you get it for 12 months. Huge. 81% plus double validity plus 15 plus batches per subject. Okay. Plus AI assistant plus e-books, mock test. Everything. Okay. New batches are just now starting. Join the new batches also. Officer Pro batch. Okay. Officer Pro batch. Join this batch. E-books, mock test, online live classes, recorded sessions, everything you are getting. Join this batch. Just now it is starting. All the subjects are starting. Join it. Okay. But for that use the code Y432. Remember, never forget this code Y432. Okay, 80% discount plus 1% extra plus on Mahapack double validity. Okay, so don't miss this code Y432. Okay.